Buying your first house will be the biggest financial move you will ever make. And buying a car just before your mortgage could not just kill your mortgage approval, but can also cost you your dream house. I have seen it happen many times when I used to work at a bank. People lose their homes not because they cannot afford it, but because they don't understand how a lender thinks. This video is going to be a crash course on mortgage fundamental, and if you are someone who's looking to buy a house between 6 months to 12 months, this will help you make smarter moves and will also help you avoid any heavy financial mistakes. Welcome back to the channel. My name is Harpreet Singh, a former financial advisor turned into a real estate agent serving Pickering and nearby areas. If you want to discuss anything about your home buying journey or your home selling journey, you can book a 15 minutes call with me with the link in the description below. So let's break down the foundation. What is a mortgage? So the mortgage is a loan that a bank give it to you against your property. So your property is being used as a collateral or as a security when they're giving you that loan. For example, you're buying a property for $800,000, you put down $100,000, the remaining $700,000 that the bank is giving you, that is called a loan or a mortgage. And when you start reading upon mortgages or even go to your bank to apply for one, you will come across definitions like amortization and terms. So amortization means the total time it's going to take you to bring your mortgage from, let's say, $700,000 to zero. Typically in Canada, it takes about 25 to 30 years depending on which option you're going for. That means you can go for a 30 years amortization or you can go for a 25 years amortization. Now, if you go for a 25-year amortization, your interest on the total mortgage will be less, but your mortgage payment will be a little bit higher than if you were to go for a 30 years mortgage. A lot of home buyers get confused between terms and amortization. So like I said, amortization is the total time it takes to bring your mortgage down to zero. However, this 30 and 25 years is broken down into multiple terms: 2-year term, 1-year term, 3 years term, and 5 years term. 3 years and 5 years term is really famous among first-time home buyers. So what does a term mean? Term means that you have the 3 years or 5 years mortgage and you will stick to the rate that the bank had given you, and after that time period has completed, then you can renegotiate the rate with the bank based on the new rates which are going on in the market. But speaking of the term, you have two options: fixed and variable. Fixed term means you're going into a 3 years or a 5 years fixed mortgage, and let's say if the bank says your interest rate is 3.5%, it is going to stay as is until your term finishes. If the market rate is going up or it's going down, it does not impact your payment. However, on the other side, the variable mortgage is tied to Bank of Canada rate. So if the Bank of Canada rates go up or down, your mortgage payment or your mortgage rate can also go up and down. And there are two types of variable mortgages. The first one is adjustable variable mortgage. In this mortgage, your payment will change, will either go up or go down as the Bank of Canada rate changes. For example, after 2021, when the rate started going up, people who had adjustable mortgages, their payments started going up as the Bank of Canada rate started going up as well. And the second variable mortgage is fixed payment variable mortgage. In this type of mortgage, what happens is your payment stays the same, but the portion of your principal and your interest changes. So let's say if you were paying $1,000 towards principal, $2,000 towards interest, as the rates go up, the portion of the interest will become higher and the portion of the principal will become lower. And going back to the time period of 2022, 23, 24, when the rates were going up, at one point they were essentially paying only interest and no principal. That's why even if you have fixed payment variable mortgages, it's always recommended that you call your bank and you ask them to rearrange your payment so you still have some portion going towards the principal. In my previous video, I talked about you putting 5% versus 20% down payment. Now, when it comes to putting less than 20% down payment, you have to pay CMHC premium. If you want to know more information about that premium, you can watch this video right here. So CMHC premium allows you to put less than 20% and still be able to buy a house. However, in this case, you have to pay CMHC insurance premium, which could be thousands of dollars and gets added onto your mortgage. And that's why it's very important for you to understand the difference between putting 5%, 10%, 20% down payment and make sure that it is the right financial decision for you. Now let's talk about pre-approvals and pre-qualification, which is a major step when it comes to your house buying journey. A lot of people, when they're thinking about buying a house, they would go on online websites, put their income in the system, and see how much they can qualify for. That is one of the ways for you to understand how mortgages work, but that is not the deep analysis of your financial situation that would help you to qualify for mortgages. So what a pre-qualification means is you are sitting down with someone and they are just running a rough calculation for you based on your income, debt, and your down payment levels. They are not pulling any credit bureau. They are not asking you for any documentation. It's a rough idea of how much you can qualify for. However, a pre-approval on the other side is a full application that is done by a bank before you even start looking to buy a house. They will ask you for your income documentation, they will pull your credit bureau, they will ask you for source of down payment, and they will give you a pre-approval letter telling you how much you can qualify for, and based on that, you can start looking for your house. So now you know what your budget is and you have an idea of how much you can afford. So when it comes to getting a pre-approval or pre-qualification, you have a lot of options. You can go to your bank or you can go to a mortgage broker. Now the difference between going to a bank and a mortgage broker is huge. A mortgage broker has access to multiple lenders. They can take your file to any of the 5 major banks or some of the 5 major banks, and can also give you access to some of the other credit companies that you might not even be aware of, and they might have better rates and products that might suit your need. But when you go to a bank, they are only responsible for the product that they are offering, and for any reason, if your application doesn't work out with that bank, then you will have to pick up that file and take it to a different bank. However, in the case of a mortgage broker, if your file doesn't work with one of the lenders, they can very quickly apply to different lenders, making sure there is no wastage of time in between. And that's why you really have to work with someone who knows what they're doing, because when you're buying a house with a mortgage condition, that means you have 5 days to get the mortgage approved. It is very crucial that you're working with someone who can get the deal done for you. I have seen a lot of clients juggling between banks and mortgage brokers and keep on shopping around until the very last minute. You have to understand this could cause delays in your house closing if the mortgage documents are not sent to the lawyers on time. So what I mean here is, the rate is very important, but in my opinion, you should look at the overall product and see how it suits your financial needs. Some of the things that you should ask your mortgage broker is, hey, can I make extra payments on my mortgage? What the penalty would look like if I break my mortgage? Do I have an option to refinance? And what if I want to take my mortgage to a different bank once my period is finished with this lender? And this point now takes me to mortgage penalties. I had a client who reached out to me and said, hey, I want to break my mortgage and move to a different house and sell this property. And I told them that you're in a fixed mortgage. That means if you break your mortgage today, your penalty is going to be upwards of $15,000. When it comes to mortgage penalties, you have 2 types of penalties. One is 3 months interest rate, which is very common when it comes to variable mortgages. Let's say you're paying $3,000 in monthly interest towards your mortgage. So in this case, your penalty would be $9,000. But if you're in a fixed rate mortgage, you will be penalized under interest rate differential, which will be a difference of your remaining time period and your original contract. And this could cost a lot of money. I'm going to put a link in the description below where you can read more about interest rate differential. So now that you know some of the basic of mortgages, now let's look at what a lender thinks when they are assessing a mortgage application. Any lender would focus on 5 C's of credit: character, capacity, capital, collateral, condition. So character pretty much means your credit repayment behavior, your credit score, have you had any late payments? All those things come under character. That's why it's really important for you to make your payments on time and maintain a very strong credit score when it comes to buying a house. Capacity here refers to income versus debt. Banks will always look at 2 ratios. One is total debt ratio, the other one is gross debt ratio. Total debt ratio means your housing cost plus your property taxes plus your heating costs plus your any other personal finances, let's say your car loan, student loan, credit card debt, divided by your income. And the second number they look at is your gross debt ratio, which is your housing expenses divided by income, and this could not be more than 39%. Capital here means your savings and down payment, how much down payment you're putting, how much money you still would have in your savings account once you have paid your down payment. All those things make a huge difference when it comes to you getting an exception on your mortgage application. Exception mean that let's say you qualify for 960 and you want to buy a house for 970. Looking at this overall picture, the bank still might be able to qualify you for 970 just because you have a stronger financial situation. Collateral and condition. Collateral here will be the property that you're buying, how new the property is, what's the condition of the property. All those things matters. Sometimes banks can refuse you from giving you mortgage for a property which is in very bad condition. And then the last C is condition. Conditions mean how long you've been working at your job security, how long you've been in the country, what's happening overall in the economy. So that's why if you're in the market to buy a house, you really want to focus on these 5 C's and you want to make them as strong as possible. So when you're applying for your pre-approval, you can get the application approved with no hassle. So once you have worked on your 5 C's and you have the mortgage pre-approval in hand, now you can start shopping around with confidence, and you will feel very confident while while putting an offer as well. Once your offer gets accepted, the lender will finalize your mortgage application. They will forward everything to your lawyer, and on the day of closing, they will transfer all the funds to your lawyer account so the lawyer can help you close on your property. The one tip I would give you here is if you qualify for 950, try to look for something which is 930, 935 so you can easily get approved for your mortgage. When you tend to go overboard, that could also lead to some complications in your mortgage application. For example, they might want to ask you to put more down payment. In my opinion, that's one of the biggest complications because as a first-time home buyer, sometimes you only have access to limited funds, and bringing that extra $10,000-$15,000 could be a big task. Let's also talk about buying a car before you buy your house. A lot of people end up buying a brand new car or leasing a brand new car, and then they go and shop around for their house. I understand sometimes people have situations, they have kids and they want to feel safe. However, a $700 monthly payment can reduce $100,000 in your mortgage qualification. So let's say if you didn't have a car, you would have qualified for $800,000, and now since you have a car payment, you might only qualify for $700,000. And the $100,000 difference could be a huge difference between you buying a house in Pickering versus you buying a house in Oshawa. That's why if you have plans to buy a house in the next 2 years, you probably want to sit down with your mortgage agent today and analyze your situation and understand how that car payment could impact your mortgage application 2 years down the road. So this mortgage basics guide was help you to make smarter moves and not to make you buy faster. And I would still recommend you to take your time and only buy when you're fully ready to buy a house. Like I always say, buying a house is very easy, but selling a house is tough. And that's why you want to make sure you're ready and you go into the right type of property that will help you make money in the future as well. So if you found this video helpful, please subscribe, and you can download my first time home buyer's guide from the link in the description below, and share this with someone who might also benefit from this video.